Hey Leon, how's it going?
Going good, going good. Crypto is kind of going sideways and stable. Stock market still going crazy.
Yep.
Uh,
Yep. Yeah, we'll get another. I think they're looking at another round of stimulus checks, so that craziness probably won't be going away anytime soon, if I had to
yeah,
guess.
I thought they needed to come to a decision really quickly, but I guess they haven't. But now there's a new date.
Yeah, there's like a new date, and the Democrats have like a new version of the stimulus thing. I think that's like a little bit more tuned to what the Republicans wanted. So
Mhm.
yeah, I mean, I feel like it's going to pass, but that is 100% my personal opinion, not based on any kind of insider information or whatever whatever you want to call it. But yeah, I mean, today I wanted to ask you about DeFi because I know this is something that you're involved in and you've got a good kind of grasp on it. I know enough about it to be dangerous, so I'm hoping to get your thoughts on it, ask you a couple questions, and then educate anybody who ends up watching us. So
Yeah,
um,
yeah. Okay,
what?
so
So oh yeah,
go
no,
ahead.
go for it.
Oh, I was just say, I guess I'll do like a 101 on DeFi. Um,
Yeah, yeah, yeah,
yeah.
yeah. Perfect. That's a great place to start.
So basically, DeFi stands for decentralized finance. And because of blockchain technology and cryptocurrencies, that's now a thing. Basically, removing the need for banks or trusted intermediaries. Now, there are some DeFi companies that are or protocols that work with CeFi or centralized finance, but for this, we're just talking about just straight up DeFi. And in a sense, one could say that Bitcoin is one of the first DeFi. It's decentralized money. Um, so, and most of the other money verbs, so like lending and interest and collateral and yield and all that, that's starting to pop up on mostly the Ethereum blockchain because at the moment they have the most development going on that
Yeah.
chain. Um,
And is that
so,
affecting the fees at all on Ethereum?
oh yeah, the fees for Ethereum are insane. Like it never even got this high during like the CryptoKitties craze in 2017 or the Ethereum bull market of 2017. And to 2017, if anyone here remembers, there was more people buying Bitcoin, but it was another major driver to that bull market was Ethereum basically decentralizing fundraising. So in the
Right.
past, like a normal company would do an IPO, which is selling a security, um, but but with an ICO, basically you could take Ethereum and invest in this company, and they give you these tokens, and then these tokens could trade in the market, and then those prices can appreciate or depreciate. And those, yeah, you didn't need a lawyer or anything to participate in that. You just needed a DeFi wallet. Um, so now, as the space has matured, and we've had a few years now of more development, and some of those projects that were founded in 2017 have launched in the last couple of years. Some big names out of that would be Compound. There
I've
was
heard of that.
MakerDAO. I would probably say MakerDAO is probably one of the earliest ones, where basically it's kind of like a decentralized autonomous organization, and you locked up Ethereum, which created a stable coin called DAI, and that whole process, how it keeps its balance, is a little complicated. But so that was one application of it, and then Compound, they had an ICO and they have a comp token. There was also Len, which changed into Aave, which is like one of the biggest DeFi projects out there now.
Right. I've heard about Aave and Maker. Yeah, you're right. Maker has been around for a while. I remember. Yeah, they've been around for quite a while. Their token's up like $600 or $700, or at one point it was. I think it's maybe down a little bit since that. But so I'm trying to wrap my head around kind of like the DeFi flow. So let's say I'm familiar with crypto. I've got a little bit of Ethereum, and I want to get involved in DeFi. It's my first move. to go to Compound or to Maker and to exchange that, lock up some of that Ethereum as like collateral maybe, and get one of those stable coins, or get like, how does, I guess, what's my first step if I'm getting into it?
Yeah, so the first step is just deciding what you want to do, right? So the basic, the most easiest thing is, hey, I have this cryptocurrency that I'm investing in, whether it's Ether or some other ERC20 token, and I want to do more than just hold it. Like, I wanted to earn some interest from it. So there is MakerDAO, but I would not advise like the app. Like, you need somebody who's a little bit more technical, and there's some risk to understand in MakerDAO. So with Compound and Aave, they've kind of like streamlined the UX UI. It's easy to kind of see and understand what's going on. So
Okay.
with Compound and Aave, you can deposit your Ethereum and earn interest on that. And also you can deposit stable coins like USDC, which is a stable coin created by Coinbase, and DAI, which is the stable coin created by MakerDAO. Or you could earn higher interest rates on those, like I believe like anywhere from 6 to 8%, which is, definitely way better than the traditional financial.
Yeah, absolutely. And that's okay. So, and that's paid out in Ethereum or DAI, or just whatever you put in is what you get as the currency you get out?
Yeah, you get paid in DAI or the stable coin. Yeah.
Okay. All right. So I'm going to see here. So to recap it a little bit. All right. So I've got some Ethereum. I go over to Compound, and instead of just having the Ethereum sit in my wallet where it's not doing anything, I want to earn interest on it. I go to Compound and deposit it in there, and now I'm earning interest on my Ethereum. And if I wanted to, I could also deposit some stable coin like DAI or USDC and also earn interest on that. So I'm like earning interest on two different kind of methods or venues, sort of.
Yeah. You can earn interest on multiple different tokens. So I'm looking at the Compound website right now, and these rates, they fluctuate based on the dynamic crypto markets. So the Ethereum, if you supply Ethereum on Compound, the APY has actually gone down a lot. It's 0.23%, which is much closer. That's much closer to traditional interest earning. Yeah, but you're earning Ether, and Ether is an asset that can appreciate in price, doesn't stay stable. It looks like DAI has also gone down, so now it's about 2.84%, which is better than traditional markets. And also, you can also borrow. So there's earning interest, and then you can also borrow these assets.
Okay.
And the rates are much better than like the traditional banks. So, a bank loan might get you, like if you're lucky, 5%, but usually it's 7 or 9% if you have good credit.
Right.
But with DAI, you could borrow DAI for 3.92%. So that's actually a pretty good rate. And you could borrow Ether for 2.94%.
Okay.
Yeah.
And there's some pretty easy ways to like get that into US dollar as well. So if I borrow, $10,000 of DAI at, I forget, you said 2.3% or
3.92 for DAI.
3.92%. I borrowed 10 grand of DAI at 3.92%. Send that over to Coinbase, cash it out into my bank account. Now I've got $10,000 in my bank account to do whatever I want with. And then, if I got to pay that loan off at that interest rate, but I don't need a credit report. I can just do that. They don't care who I am as long as I've got, the technical expertise to kind of go through this process. And yeah, that's cool. That's really cool. That's literally, it's decentralized lending, decentralized.
Yeah. Kind of literally no bank required. And in fact, so that's DAI at 3%. You could even borrow USDC for 1.78 and Tether for 0.85%. So less than 1% interest. APY. So
Are they just giving me this, or do I have to put up some like collateral? Like I've got to collateralize it, right?
Yes, yes. Pretty much all DeFi loans right now are all collateral based. So that removes the need for credit checks. So basically, you deposit, say, $10,000 in Ethereum. It's in a safe. I believe you can withdraw up to 70%, but it's safer to withdraw 50%. So
Okay.
you take a loan of 5,000 out of that, and then another great thing. There's no time limits. There's no monthly payments. You pay whenever you want to, but interest does accrue every day. So it's that 3% divided by 12 months.
Gotcha.
Yeah, so that's another great thing.
It's a little different. It's a little different than the bank, because I mean, the bank might make you sign over, make a personal guarantee. So you're putting your house up, you're putting your car up. So I mean, in that sense, it's the same. But like a small business loan just based on a credit check, like without collateral, that's not in the DeFi system yet. But if you're talking about, hey, I've got a chunk of my portfolio or my investment portfolio, it's just sitting there. It might be nice to have a little bit of, cash to do, something else with. Let me deposit that on there, pull that cash out, and then kind of lock up that Ethereum or whatever that collateral is that I'm using it. I can't use that, but I get the cash to do whatever I want with, and at this low interest rate. Okay, that's making sense.
Yeah. So you got the earning interest and you got the borrow side. Like both of those, like one of the two biggest money verbs covered in DeFi, and yeah, it's very liquid. You can get in and out.
Large amounts in and out, not a ton of slippage. You're saying.
Yeah, and so there's that, and I have used Compound. I did Compound with a little bit of yield farming with BAT token for a little bit. I'll get into that.
I was going to say, I definitely talk about yield farming.
yeah. But I mostly use Aave, so I've deposited on Aave, and I've taken out collateralized loans on Aave. So I've taken out DAI, I've taken out USDC. And I personally use that to buy more Ethereum because based on my thesis that Ethereum is going to continue to go up.
Okay, I see. So you got, like, just hypothetically, you've got $1,000 of Ethereum. You put that through Compound. You get $500 worth of stable coin. So Tether or USDC, that's kind of the safe percentage to take out. You go and you buy more Ethereum with that, and then if the price appreciates over whatever your interest is, you can then sell that Ethereum and then recoup your original investment and have a little bit of stable coin left over, or a lot of stable coin if Ethereum really hops up. So it's kind of like a leveraged long in a way.
Exactly. Yes, it's like taking out leverage. It's like taking out margin in the traditional world. And so with that does come the risk of getting what's called a margin call. So the asset that you're lending or getting locked up for your collateral, it has to maintain this certain value, right? This LTV, or loan to value ratio.
Right. The Ethereum that I'm locking up in this hypothetical situation has to be worth at least as much as the DAI that I've pulled out, which is why you recommend only pulling out 50% of what your collateral is, right?
Yeah. And on most of these sites, it'll let you get up to 70%, but once you get to 70%, it's like you'll get a warning, hopefully, or you just need to monitor it. And once you get past that, what could happen is, this is Ethereum dropping in value. You have to either deposit more Ethereum or pay back some of your loan to bring that LTV back down. Because if it stays at 70% or higher, you have like a few days or so, whatever is programmed, and some of your Ethereum will get sold off to bring your LTV back down. and that's all done programmatically. There's no person like managing these loans.
Right. Yeah. I mean, it's a piece of code that says if the value of what you've deposited is less than what we've given out to you, or we're getting close to that, we're just going to sell everything that you have so that the system continues to work and that you don't default on your loan. So you really, it's basically almost impossible to like default on your loan because they just liquidate you, right?
Yeah, exactly. There's no risk on the lender's side. Yeah. So yeah, so the interest that you're putting out, I mean, there's no risk for that never getting an interest because that interest is pulled from all the people loaning their assets. Yeah, and you don't get all of it sold off. You will get some sold off to bring that LTV down. Yeah.
Okay. Because I'm imagining, I've messed around on BitMEX a little bit, and super high leveraged trades and things like that. And I mean, you can wipe your whole stack out pretty quickly. So I'm kind of relating it to that a little bit, but it doesn't sound like. I mean, there's some similarities, obviously, but it's not the same. They're just going to sell off the minimum amount that they need to keep that loan to value ratio where the code has determined it needs to be at, or the preset rate that it needs to be at. So you might lose a little bit of it, but you also get a warning and you get the opportunity to put more collateral in there to avoid that happening. Okay, so there's definitely, it's not like this risk-free, free money thing that I feel on Twitter, it kind of comes across as like, for the people that understand DeFi and all of this stuff, it's basically just free money and there's no risk. And like, why aren't you doing that? Why aren't you in this, you dummy? But then when you look into it, it's like, well, no, okay, so I can get, screwed here. I can lose my money here. I can lose my money here. And this is only this is like only kind of the first part of it, because we haven't even gotten into the yield farming. This is just kind of like the initial setup to where, okay, you've got a loan, you've got some leverage, you've got some stable coin that you can do something with or whatever. So this is just like step one.
Yeah, this is step one. This is like the safest part of DeFi.
Right. Yeah. Okay. That's a good disclaimer. This is the safest part of DeFi, what we've just discovered, or what we discussed.
Yeah. Compound, Aave.
So where do you go from here?
Yeah. So what I've been doing, which is leveraging up my Ether position. To some people that's a risky thing because some people just want to have no potential of a margin call. But I'm fine with that risk because I know how to manage that risk. Either I know how to read technical analysis and know what the market structure is. I have capital on the side to intervene, either depositing more Ether or paying out the loan, to kind of manage that position.
So, would it be safe to say that you have experience and you're not using more money than you're willing to lose in this, and you actually have some extra capital that you've set aside to help out in case you do get close to that margin call?
Exactly. Yeah.
Okay.
Yeah.
That sounds like a smart plan. I don't know that everybody does that, but if you are looking at getting into this, take some advice from Leon here, and sounds like you got a method that works for you. I guess it's different for everybody, but it sounds like a good approach. And anyway.
I recommend definitely don't try the YOLO strategies. Because crypto is so volatile, right? You can have 20% moves in a day, both up and down, and you put your loan at risk and your position at risk, and you get liquidated, and that's not a good feeling.
Been there, don't like it.
Yeah, and before we get to the yield farming, there's some other stuff in DeFi that's not really the interest or loaning, but there are these synthetic assets. So there's synthetics. And their token is SNX, and they're tokens that follow. They're kind of like derivatives in the traditional market. So It's like you're able to buy a synthetic token that tracks Bitcoin, or you could track a stock in a specific company, or basically you could create a synthetics for anything really. So that's it's like new financial instruments in crypto. So that's kind of a cool thing. And then there's another protocol called set protocol. So these set protocols, they're more complicated tokens, which it's basically like these portfolios based on 60% Ethereum, 40% Bitcoin, or some
Okay, so
variance.
it's a basket of cryptos.
Yeah, yeah.
Okay.
So you can trade those too. So yeah, if you're looking to find some interesting mix of assets, they're kind of like mini ETFs in a way, but they're programmable too. So based on moving averages and price movements, the balance in that token can shift from like, well, the easy one is like there's 50% ETH or WETH, which is wrapped Ethereum,
Okay.
and then 50% DAI. So in any moment, it could be 100% ETH, 0% DAI, but then it could rebalance based on some algorithm to 100% DAI and ETH. So these tokens are kind of trade themselves almost.
So as a DeFi trader, you're basically, these tokens are kind of, the basket is like rebalancing itself according to the code, and you are taking a position that the I guess the code that's rebalancing it is going to do its job correctly and increase the value of the basket or decrease it. You're taking a position on one or the other side, or I guess, how do you trade them?
Yeah, so on set, the simplest one is like, so there's an ETH long one basically. So if you're long ETH, there's a simpler way, you just hold ETH, right? But based on a moving average flip, that asset could automatically rebalance to 100% DAI instead. So it's kind of a token that's kind of built to kind of protect you from downsides.
Okay.
In a way. So it's kind of they're neat tools to kind of like diversify your crypto portfolio. Now, here's the risk with these assets though, synthetics and set token, because
like there's so many variables. Like I'm already my risk radar is kind of going off, because it's like, I mean, there's just, okay, so I need to understand like the code and how this thing is balancing itself. Plus, you know, my initial foray into this, I've got my collateral at whatever point I've taken the DAI out, 50% of my collateral, I have that in stablecoin now. That's what I'm using to trade these synthetics. So that, you know, that's a little bit of risk. And then on top of that, is a smart contract written properly? Is the code good? Has it been audited, or is it trustworthy? And then even if all that is true, the market may just, you know, go down, and the algorithm that's rebalancing it might not, you know, do its job as well as I thought it would, and so I lose. So yeah, the feeling I get is there is an absolute monster amount of risk involved with this.
yeah. I would say two major forms of risk. So yeah, one, like you said, there's the smart contract risk. If for some reason it doesn't execute as expected, I believe that the team on set protocol is a pretty good team. So
right, yeah. There's different teams that have good track records and stuff like that, which definitely want to prioritize them.
Yeah, but the other risk, and this is only I found out myself because I use a small amount, like $100 to buy a couple of set tokens. Now, because these are complicated smart contracts, there's more transactions that take place to close it, to exit, or to open it, right? So I didn't realize this. So it actually cost me more to withdraw my token, to withdraw my ether from that token, than the profit that has made me already. So you have to So it only makes sense if you have large capital in these assets. You need a lot of money to make it worthwhile to execute. So otherwise you're just stuck with, that's $100 I'm never going to see again, because why would I cash it?
Right, yeah, it's got to go through 50 different smart contracts and this and that, and each one of those incurs a gas fee on the Ethereum network. And so, yeah, if you're not playing with thousands, tens of thousands of dollars, tens of, how much? I mean, what's kind of like, what's a lower amount that you can get in?
I think 10,000 would be makes sense. Yeah, because we're talking about fees that are like $80.
Right. Yeah. So, and that's on $1,000. That's a pretty
Yeah.
That's rough.
So, yeah. So that's that side of the world. So yeah, with yield farming, and this kind of really blew up earlier this year. So the basic yield farming started out with you had Compound launching, you had Aave launching, and then you had these different tokens. Like on Compound, you've got DAI, Ether, Tether, 0x, Wrap BTC, which is Bitcoin on the Ethereum network. You have Augur and BAT token. And for a little bit of time, BAT token was giving you a 20% or 25% APY.
Are you saying BAT, basic attention token, like the Brave?
Basic attention token, yeah.
Okay. Sorry, I just wanted to clarify that. I thought you were saying BAD, like BAD, like bad. But BAT. Yeah. Gotcha.
I think there's a podcast called Bad Crypto, and they have a BAT token, but I don't think it's working.
Yeah, I've heard of those. Yeah, I've heard of those guys.
Yeah. So with BAT token, I saw that and I was like, okay, I'm gonna take advantage of that. So I deposited some BAT, and then you're getting 20%, but you're getting 20% in BAT. So and then but you have to time this right. You have to watch, because these are dynamic. Like the more people deposit their asset, the lower that API goes down, right? So
gotcha. Okay.
It was 25%. Now I'm looking at it, it's 0.01%. So it's like, yeah, there's no point even like.
From 22% to 0.1.
Yeah.
So basically almost nothing.
Yeah. So what early traders were doing, they're looking at all these different interest and loan marketplaces and protocols, and there are a bunch of them, and they're looking like, okay, hey, Ether over here is giving me a good rate. If I borrow it over here and I lend it over here, I have a gain over here. But now, and then you're looking at another asset you can do, and another platform you can move it to, right? But see, the more platforms you start doing this yield farming on, like you have, again, it starts to make sense once you have bigger and bigger amounts.
Right. Because every time you transfer, every time you move it, you're getting hit with that gas fee, which hypothetically, $80 is kind of what you were saying. So it's like, okay, I got you. I'm following you.
Yeah. So that was like yield farming 1.0, and then now you had like this new wave, which is so crazy and fast. It's hard for me to follow. So you've got like Yearn Finance and Yam token, and then all of a sudden you've got all these like food tokens, right?
Yeah. Sushi coin, hot dog, like all this crazy stuff. Where
and I'm still not sure on how this math worked out, but they were able to get like people who would get those tokens, and they were able to get interest like crazy, like 50% APY and stuff like that. Then I guess one protocol would drain out, and then everyone would go over to the next one, and it just crazy, like how fast it was moving and how insane the returns were, which is why I kind of personally stayed away from actually ever trying those, because I was like, something that sounds like too good to be true, Right.
Well, yeah, I mean, it's like, it's what I heard is a lot of it is you get, everybody kind of like floods into sushi coin or floods into hot dog coin, and then as more and more liquidity enters for it, then people start pulling out, and it's kind of like that classic pump and dump where like the last person in ends up holding the bag. So if you're not pulling the trigger and kind of knowing very accurately what you're doing, and have you got some experience, and you've maybe automated some of these transfers versus like actually doing it with your mouse and like my crypto hardware wallet or something like that, you've got it happening on the back end using code. You're probably going to be the person that's ends up holding this bag when the token just goes through the floor. That was my read of it, and I don't know if that's accurate or not, but that was the vibe I got.
Yeah, that's kind of my read on it too. And not only do you have to pay attention to the charts and stuff, but you kind of have to pay attention to the inflows of transactions to the smart contract. Okay, how much more money is coming in? Am I still in a good position, time frame to get out?
Right.
Yeah, and Yeah, so Sushi is basically a fork of Uniswap. So yeah, so before Uniswap they didn't have a token, and so Sushi is kind of like a governance token. Real quick, like, I think it was YeFi. That token is only 30,000 of them, but it got bought up so much because of all the rates they were getting. Like it's like 20,000. It hit like 30,000 a token. Like it was more than Bitcoin at its max. Now, but which is pretty crazy. But yeah. So going back to Sushi, so with Sushi, people were all jumped on there, and then they had a little drama because the developer of Sushi, he cashed out like 18 million.
Yeah.
And then he had to go on Twitter and social media saying, "Oh, I'm sorry, I panicked." I see that's risk I don't want to even.
I accidentally became a multi-millionaire overnight. Like, I'm sorry, I panicked.
Yeah.
Okay.
Yeah. So that's why I've stayed away from all of that stuff. So Uniswap's been around for a while on Ethereum,
right?
So they're a good team, good history.
Yeah, I've used Uniswap. I like their product or service or whatever you want to call it. Their decentralized exchange.
Yeah, I've used them a lot too. I've used them to trade tokens here and there pretty seamlessly with MetaMask. So they saw the success that happened with Sushi. So they went ahead and created their Uni token. So it's a governance token. And they just did this awesome airdrop. Now, unfortunately, you had to have used Uniswap before September 1st. Mm-hmm. And it didn't matter how many different MetaMask accounts you had. Now I wish I had made more MetaMask accounts, but
I know I only had one. I only went back and was able to find one. I was like pouring through all my old Ethereum wallets, like trying to and going over to Etherscan and like putting them in, like come on, like show a Uniswap transaction, and I only got one. But I think it's like $1,900 or something, like $1,700, almost $2,000. Of Uniswap token that just got airdropped, or I'm sorry, I had to go to the website and claim it, but then it just went into that wallet that I originally transacted with, and I sent it over to my main hardware wallet. But yeah, that was a nice surprise to wake up to.
Yeah, it was kind of like a nice crypto stimulus package, I guess, because
yeah,
right. when it first came out, I believe the token was already trading. So this tells me there are a lot of VCs and big money behind this for Uniswap. So the investors in Uniswap and partners on Coinbase and whatnot, and they got the deal done to have it listed on Binance. It cost a few $1,000s to get that token listed on Binance. And not only that, but Uniswap also got listed on Coinbase soon after. Like that was one of the fastest listings on Coinbase ever.
I did not know that Uniswap is on Coinbase. Wow.
Yeah. What's crazy is YeFi just got on Coinbase too. And now it's at 23,000, I think.
Interesting.
That's on Coinbase.
Interesting.
It's like, yeah.
So DeFi is coming. I mean, this is like this is getting some traction at the highest level. I mean, in my opinion, Binance and Coinbase are kind of, I don't want to say gatekeepers, but they kind of are gatekeepers. Like if you can get listed on Binance or Coinbase, like you've kind of, in the crypto sense anyway, like you've kind of made it. Like, right? Like they're the big boys, right?
Oh yeah. Pretty much Coinbase in the US and Binance internationally, and then Binance. I mean, this is global. Like the volume is just tremendous.
Yep.
But yeah, so it's what's interesting. The information arbitrage here is you're seeing this happen so aggressively in crypto right now, right? And also in traditional world, we're starting to see banks being allowed to finally store crypto currencies with their clients. Like, yeah, the innovation here is just forcing, it's pulling the traditional world into the modern crypto blockchain world, kicking and screaming.
Right. Well, yeah, no, that's interesting. And I think on one of our other events, you were talking about you in your opinion, you see the institutional investment as more of a driver behind crypto price appreciation, if I could speak here. Really, that's where like the main source of like new money coming into the space is going to be coming from these institutional sources, whereas in 2017 it was primarily the retail market. I mean, there's definitely some institutions in there, but it was mostly the average person hearing about it or getting excited about it, wanting to make a little bit of money and buying some Bitcoin or whatever. So I mean, I know we're getting a little close to our time limit, but I mean, maybe if you want to give some thoughts on that, and that might be a good place to end it. Or if you have anything else that we need to know about DeFi, definitely share that too.
Yeah, I'll also share a couple of things. But yeah, so speaking on that, 2017, and so that was like retail mom and pops, and but that's a segment of a small segment of the investing population of like America and the developed economies, right? Those are the riskiest takers. They're the riskiest risk takers, right? So the early mass majority of investors, they're still going to come, but they're going to come in what I feel after much more major money comes in from institutions. And like with this bank thing that just happened like this year, we're going to see products and services roll out in the next couple of years, making it easier for the mainstream consumer to get involved. And I feel they're going to get involved not really from Coinbase, but more from Fidelity or Chase, which is funny.
I mean, according to the OCC, the Office of the Comptroller of the Currency, I think I'm saying that right. Like the bank is going to be a custodian for your Ethereum, for your Bitcoin, and then also for your stable coin, your DAI. I mean, that's all the stuff that you're using to get into DeFi with. And then there's these, new decentralized financial instruments, kind of, these baskets of coins, these derivatives like that you talked about. All of that's going to be made accessible to the public and the bank, and it's going to be facilitated through the bank, holding it. I mean, very similar to maybe like a brokerage account or something if you're, a day trader in the stock market currently. Is that fair?
Yeah. So each one of these all this innovation is happening fast, and some are crashing and burning, and some are like staying and more stable, but they're eventually going to trickle into the mainstream world, right? So we're going to see that access through traditional banks, but then we're going to see companies that not traditionally weren't banks, like Square is turning into a bank. And they're very crypto friendly. Coinbase will eventually get their bank chapter, and I'm sure Gemini eventually as well. So we're going to have like these hybrids of banks/exchanges, and then potentially, once staking services get hey, here's an interest account for your checking. How about earning these staking rewards for this crypto you can invest in, and then you have a suite of. Now the products become endless that the vast majority retail gets access to. So that's coming. I'm excited for that in the next few years. In terms of current DeFi evolution, so it's still going on Ethereum at the moment, but that's really been stressing the Ethereum blockchain. And Ethereum 2.0 is coming, but it is getting deployed in phases. And I think from what I know last, it's going to take like a year to 2 years for Ethereum 2 to be fully up and running. And I'm sure some parts will get running up earlier than others.
Right.
So that's a window that's kind of open up for, other blockchains to kind of like take advantage of this crypto DeFi explosion. And from all the competitors I've seen, Polkadot's the most exciting one in that area. For a few reasons. One, it's got one of the founding teams from Ethereum in the first place, Gavin Wood.
Yep. Yeah. No, Polkadot is a very interesting.
He's the CTO of Ethereum. He's like the head of Polkadot, and because of their parachain system, it theoretically can do 1 million transactions per second once all the parachains and relay chains are up and running. So that's something I'm paying attention to.
Yeah. Yeah. But yeah. So I mean, let's see here. I want to recap this a little bit. So the DeFi thing, I think you get some very passionate arguments for it and against it, and kind of the social media crypto Twitter, if you want to call it that. And it sounds like with most things, it's kind of somewhere in the middle. Like, yes, there is some serious risk, and there's more than 5 different ways that you can lose your investment. But if you know what you're doing and you're willing to put the time in and maybe lose a little bit in the learning curve on how to like properly do this, you can make some serious change on it if you've got the funds, you got the deeper pockets, and the time to look at it. But there's definitely quite a bit of risk. But also at the same time, if you only want to do step 1 and you want to make a little bit of interest on the Ethereum that's been sitting in your wallet since 2016, if you're lucky, you can do that, take out an over collateralized loan, and get some literally US dollar or crypto or whatever form of currency you want to do whatever you want with, as long as you're able to pay that back, and your loan to value ratio doesn't get too bad to where you get margin calls. So you don't have to use all of DeFi. You can use a little bit of DeFi to get some of the benefits, the lower risk benefits, or you can go full tilt. But it's not, I don't know, it doesn't feel like it's a scam, which is what I see a lot of people saying on Twitter. Like, this is a scam. It's crap. It's worse than the ICOs. I mean, yeah, some aspects are probably a little pump and dumpy or a little
scheming.
Yeah. But I mean, I don't know. Like, I don't want to. I mean, it's the crypto space, right? We're in the Wild West. We're just kind of throwing a bunch of stuff at the wall and seeing what sticks. Will this stick? I bet some aspects of it will. I mean, I'm pretty confident because the banks and the institutions are starting to get into this, and they want a piece of this pie, which to me is actually a pretty, that's going to be interesting to see how that plays out. And it's not something that I want to write off if you've got people with those deep of pockets showing interest in it. So.
Yep, exactly. I guess one more thing is, like, earlier in this year, the amount of assets under management or dollar value in DeFi was around 400 million, and this summer it hit 9 billion.
So it went from 400 million to 9 billion.
Yeah. That's insane growth.
What time period?
About like 6 months or less, more like 5 months. Yeah.
Holy smokes. Okay. So yeah. So more than just somebody, quite a few people are getting into this in a big way, or lots of smaller people.
Yeah.
Okay. Well, cool. Well, I thank you. I really appreciate you giving me the lowdown on it. I definitely have a better understanding of it than I did before we sat down here. So yeah, I mean, I appreciate your expertise, and I think that's probably a good place to end it. Before I do that, though, do you want to share Twitter or website or a little bit about what you're up to or what you're wanting to put attention on?
Yeah, so I'm the host of the Dallas Bitcoin Meetup, and so if you Google Dallas Bitcoin Meetup on meetup.com, you can find our meetup there. It's all online for the moment, and actually soon I'll be hosting Polkadot Dallas meetups as well. And I'm on Twitter at Leon Gaban, LeonGaban.
We'll throw that in the description.
Sweet. And I'm also a moderator for dumbmoney.tv. And they're a channel that talks about stock investing and trading. And I'm kind of like the crypto guy in that community, trying to help teach these traditional investors and traders, hey, there's opportunities over here in crypto. You should look at it. So yeah, you can find me there too.
Awesome. Well, thanks, man. I appreciate it. I think we're going to wrap it up there. This is Matt from the Open Economy Initiative. Check us out at the OpEI. theop.com. We got a great course on how you can get your feet wet with Bitcoin and make your first Bitcoin purchase the right way. That's over on the website. You can find us on Twitter at the Open Economy Initiative. And yeah, we're going to keep bringing you all videos like this. We got a great group of experts in the different areas of the crypto sphere. And so, yeah, thank you again, Leon, for giving us your thoughts on DeFi and explaining it to me. And yeah, we'll probably talk with you again soon here, man.
Yeah, thanks. Right.
All right. See ya.